You may have noticed more and more people talking about this chart recently, which is the reverse repo facility at the Federal Reserve, which you may notice over the last 6 months has been crashing. Not only that, but the pace at which funds are being drained out of this reverse repo facility has drastically increased over the last few months, and it's not slowing down anytime soon. So what exactly is going on here? What happens when this facility hits zero, and why is it so important to inflation, market stability, and most importantly, money in your pocket? Well, contrary to public opinion, if you want to be able to tell the future, you don't need a crystal ball, you just need to be able to know the past. So let's take a little trip back in time to before the financial crisis. The repo market was a place where banks could go get cash for their overnight funding needs. If you're a bank and you come to the end of the day and you need some cash, well, you've got some collateral, so you go to the other banks and you say, hey, I've got some collateral, can I give it to you? You give me your cash, and I promise to repurchase that collateral back from you at a future date. That's why it's called the repo market, for repurchase, not repossess. If you think this sounds anything like a pawn shop, you're exactly right. It operates the exact same way. Most people are not aware, but during the financial crisis, the reason why banks were in so much trouble is because of the repo market. Banks would go to the repo market with their collateral, but all the collateral they had was just mortgage-backed securities. And at a certain point, I didn't want to accept mortgage-backed securities. You didn't want to accept mortgage-backed securities as collateral, but we all need cash. So suddenly we're out of luck. This was the first time the Federal Reserve intervened in the repo market to be the lender to inject the cash into the repo market and be the one to accept that bad collateral. This way, none of the banks fell over as a result of not being able to give their bad collateral for cash, and they just promised to repurchase them at a future date. If we fast forward to September of 2019, we saw something very similar begin to unfold, and it scared a lot of people. In September of 2019, the repo rate spiked, and it moved very similar to what happened during the financial crisis. Banks were going into the repo market trying to get their hands on cash, but nobody had cash. So this raised concerns. Many people were afraid that there was bad collateral again in the system. Turns out in September of 2019, that actually wasn't the reason why the repo rate spiked. In 2019, the reason was because there just wasn't any cash. So the collateral was all good. All the banks were coming to the repo market saying, hey, I've got US treasuries. Can I give them to you for cash? But everybody was doing the same thing. And so the rate for that cash spiked. Again, in order to prevent banks from being at risk of collapsing, for not being able to find that overnight funding that they needed, the Federal Reserve intervened again, started injecting cash into the repo market for that collateral. The reason why the system didn't have any cash at this point was a combination of two factors. Number one, it was because the Federal Reserve had been doing quantitative tightening, letting assets bleed off of their balance sheet, which sucks cash out of the system. You can see they had to reverse course in September of 2019 to inject cash into the system yet again through the repo market. The second reason was because the US government had continued a high rate of borrowing, and so the government was issuing debt, which was collateral for the system, but there just wasn't enough cash for all that collateral. If we fast forward a couple months from there, we get to the beginning of 2020, and we all know what took place in 2020. Record amounts of money printing, with the Federal Reserve printing trillions of dollars to blow up its balance sheet, which contributed to one of the largest spikes in the M2 money supply we've ever seen. The way the Federal Reserve prints money is that they purchase US treasuries from banks, and then the banks take that new cash and lend that new cash to the government in exchange for treasuries. So they're just playing the middleman between the Fed and the government so that the Fed can print money and have that funneled through the banks to the government. The government then spends that money, which then winds up in people's bank accounts. This means that when we take a look at the trillions of dollars that the Federal Reserve printed, not only did those trillions of dollars enter the banking system as deposits, but the Fed also sucked out a lot of collateral from the system by buying all those treasuries. So now, starting in 2020, we actually have a new problem. The problem used to be that there's not enough cash and there's everybody with good collateral, but there's just not enough cash. Now, starting in 2020, the system is flipped. There's a ton of cash, actually too much, I'll explain why in a minute, and there's not enough collateral. You see, when you put $1 in the bank account, that is your asset because they owe it to you, but it's the bank's liability because they owe it to you. You are a lender, they are a borrower. So if they don't do anything, that's costing them money because they have to keep the lights on, they have to pay the salaries of the people who work at the bank, and so Well, that's a cost. They have to take your dollar, do something with it to make money so that they have an asset that offsets that liability. So in 2020, we had trillions of dollars flood into the banking system, and banks were like, hey, there's going to be a problem. We're going to have to take these trillions of dollars and go out and find collateral, and there's not enough collateral there anymore because the Fed just bought it all. This is why in April of 2020, the Federal Reserve announced a temporary change to what's called the supplementary leverage ratio rule. Essentially, this gave banks 1 year that they didn't have to worry about finding collateral for their liabilities for those deposits. However, that was not a permanent suspension, and we see that on March 19th of 2021, the Federal Reserve announced that the supplementary leverage ratio that was temporarily suspended would expire on March 31st of 2021. So banks had 1 year in which they didn't have to worry about finding collateral to offset all of those cash deposits. But starting in April of 2021, suddenly they have to worry about it again. And interestingly, starting in April of 2021, we see the reverse repo facility begin to get used. Remember, prior to 2020, when the problem was there's not enough cash, banks were going to the repo market to get cash that the Fed had to intervene in. But now, post 2020, the problem was we need collateral, and so the banks go to the reverse repo facility at the Fed. Any dollar that enters into the reverse repo facility at the Fed is exchanged for collateral. So these financial institutions were able to push cash towards the Fed and get the collateral that they needed. And starting in June of 2021, we see that the interest rate the Federal Reserve started paying on money that was in the reverse repo facility went from 0 to 0.05%. Basically, the Federal Reserve saw that there's a ton of cash in this facility, and we want to make sure that this is the floor under interest rates. We cannot have interest rates going negative. If this cash goes out into the system and starts buying T-bills, especially anything longer term, we could have rates lower than we want them to be. So the Federal Reserve started paying 0.05% on any cash that came into the reverse repo facility to incentivize cash to go to the reverse repo facility for collateral instead of buying it for the open market and manipulating prices. Essentially, the Federal Reserve was using their federal funds rate in addition to the interest rate paid in the reverse repo facility for monetary policy to make sure there was a floor underneath interest rates. And we see the results of that once they started paying an interest rate on the funds inside the reverse repo facility in June of 2021. The amount of money kept on flooding in for months and months on end until it peaked out starting in June of 2022, about a year later, at $2.3 trillion, and it stayed around $2.3 trillion until May of 2023. During this entire time, the Federal Reserve was raising the rate that it paid in the reverse repo facility every time they raised interest rates. Again, this was to keep a floor underneath interest rates so that their monetary policy could be effective. For the next moment, I'd like to share with you about a very important company who is sponsoring today's video, Monetary Metals. The reason why Monetary Metals is doing something so revolutionary goes all the way back to when FDR outlawed gold ownership with Executive Order 6102. What a lot of people don't know about this gold confiscation was that it also outlawed the gold clause that was very common in debt contracts, which allowed people to get their debt paid back to them in gold if they chose. Fast forward from there to 1971, when the US left the gold standard for good, there's no longer any reason to keep this law in place. But what even fewer people are aware of is that this law was actually repealed, which meant that it became legal to denominate debt contracts in gold yet again. Now, for the longest time, I was not aware that this was legal in the United States, let alone that there was any company out there actually doing it. However, when I discovered Monetary Metals, I realized this is exactly what they're doing, and nobody else is. They have created a way for you to get on your own personal gold standard by paying you a yield that is denominated in gold, it's priced in gold, and it is paid in gold. They have multiple offerings like leases that pay between 2 and 5% and bonds that have paid up to 19%. Now, just to be clear, this means that if you start off with 100 ounces of gold at 4%, then you end the year with 104 ounces of gold. The yield is denominated and paid in gold, regardless of what the price of gold does. Your gold is actually growing. Now, I have spent quite a bit of time over the last 2 years now researching how this company does what they do. I've gotten to know the team, and as a result, I've not only become a customer of the company myself, I use the products, but I've also invested into the company personally. Monetary Metals is doing something truly unique, revolutionary, by paying you a yield on your gold, priced in gold, and paid in gold. And I highly recommend and encourage you to click on the link in the description below and open up an account today. Okay, so now you're up to speed. By May of 2023, the reverse repo facility is primarily being used as a place to get a risk-free return on cash. The money in here is primarily coming from things like money market funds, as cash has left banks that don't pay anything and gone into money market funds because it winds up in the reverse repo facility where you're getting paid directly from the Fed, the money printer. Yes, things like US Treasuries are considered risk-free, but even Treasuries carry some tiny amount of risk. If you're getting paid an interest rate directly from the only one with the legal monopoly on creating money, and it's 100% liquid, it's very difficult to beat. And that's why for about a year, the amount in the reverse repo facility was steady at around $2.3 trillion. But something changed in May of 2023. As you can see, in May of 2023, the reverse repo facility started to get drained, and it has gone down ever since. This is a chart of the money supply. You'll notice the money supply was also declining until May of 2023 when it started moving sideways. And this is a chart of the 6-month US government treasury. You can see interest rates were increasing on this until May of 2023 when interest rates stopped rising and started moving sideways. So what in the world do these three things have in common with each other? Why on May of 2023 did we start to see the reverse repo facility get drained, the interest rates for 6-month treasuries start to flatline, and the money supply start to move sideways? Well, it has to do with the reason why that cash is in the reverse repo facility right now. That is short-term cash, mostly from money market funds where you have short-term liquidity needs, and also you're looking for the best rate, highest risk, lowest return. Throughout this entire time, when the government was having to pay higher and higher rates on its short-term debt, the reverse repo facility still made the most sense. If I'm going to put my cash somewhere, it makes more sense to get it from somewhere with less risk and a higher return. But by May of 2023, for a 6-month treasury, it was paying 5.4%. Conversely, in the reverse repo facility, it was only getting paid 5.05%. So starting in May of 2023, the risk to reward ratio flipped for some of that money. If I'm a money market fund, now I don't want to keep everything in the reverse repo facility because I can get a higher rate by putting it in T-bills. So I'm going to take some of the money out of the reverse repo facility and put it into T-bills so that on average between the two, I'm going to get a higher rate and I still have the liquidity I need from everything in the reverse repo facility. That's why the interest rate on the 6-month stopped rising starting in May of 2023 and started moving sideways. Because every time the US government borrows at the short end now, there's demand for that short-term debt. It simply draws more funds out of the reverse repo facility. Now you're probably thinking, but wait, what about the money supply? Because the money supply, like we saw, was dropping up until May of 2023. Then it started moving sideways because the Federal Reserve was still in tightening mode, raising interest rates and quantitative tightening, which is letting assets bleed off of its balance sheet. Those two things by themselves have an impact that would lower the money supply. And that's exactly what it was doing. But any of the dollars in the reverse repo facility are not inside of the money supply. And so as the government borrows more money at the short end of the curve, pulls that money out of the reverse repo facility, it's borrowing it so that it can spend it. Where does that go? It goes into people's bank accounts. Essentially, it reintroduces the money from the reverse repo facility back into the banking system, which impacts the money supply. So the increased government borrowing finally reached an interest rate that was attractive enough to pull money out of the reverse repo facility. facility. That money then gets reintroduced to the banking system, perfectly counteracting the tightening the Federal Reserve was doing and canceling out any rise or decline in the money supply. The Treasury announces its plans on how much debt it's going to be issuing, how much money it's going to be borrowing, and whether it's going to be doing that at the long end of the curve or the short end of the curve. And they announced that they are going to be relying heavier and heavier on the short end of the curve, T-bills, because there's currently $912 billion in the reverse repo facility that will come out to be lent to the US government at the short end. So they can borrow up to $912 billion at the short end without worrying about it pushing up interest rates. If we take a look at how quickly the reverse repo facility has been draining since May, then that puts us at about March or April by the time this facility is completely drained and empty. Again, this is not something the Federal Reserve directly controls or prints money in or puts money in. This is just free market forces like money market funds saying, where do I want to keep my cash? The more the government borrows, the more attractive it is to pull the money out of there and give it to the government through T-bills instead. But if we take a look at how fast the money's been draining out of here since October, then we could see this account be fully drained by January of 2024. So sometime between January and April of 2024, it's almost certain this account will be at zero. Essentially, what that communicates, based on what we know about how the repo markets work, is that there's no longer the problem in the system of not enough collateral and too much cash. Once this facility hits zero, that is a signal that there's no longer too much liquidity and too much cash in the system. The absolute monstrous appetite for government borrowing has absorbed it. So what exactly happens when this facility hits zero? Well, three things. Number one, interest rates start to pop again, because then every dollar the government borrows, they have to source from somewhere that's not already getting paid a lower rate. In a situation where liquidity has completely dried up, the borrower, who is borrowing hundreds of billions of dollars a day, is going to have to do so by offering a more attractive rate. So interest rates will be going up. The second thing that will happen is the money supply will actually start to move down again, because there's no more $1 trillion waiting outside the system that is constantly being reintroduced to the banking system. At that point, it will all be sucked back in, but the Fed is still doing quantitative tightening and rates are still high, which causes deleveraging. Those forces will become the dominant force yet again and will cause the money supply to start to drop again. And yes, when the money supply continues to drop, that means liquidity is drying up, which is also a factor that contributes to higher rates. These things feed in on themselves. The combination of those two factors just means economic pain. And yes, it's true that markets have started to price in a pivot from the Federal Reserve again, but in the last 2 years, 7 separate times the market has priced in a Fed pivot that never actually came. We are also seeing expectations of a soft landing increase, which is a contrarian indicator. In the past, optimism about a soft landing usually peaks right before the big economic pain starts. And if you're sitting there thinking, well, yes, but still, for any significant economic pain, for any serious recession to take place, you have to see an increase in unemployment. Well, unfortunately, these two charts that were posted by EPB research show that both the leading and the coincident index of employment are following the average paths that happen post an yield curve inversion. We know the yield curve has been inverted in the US for quite some time now, and on average, what happens every time after the yield curve inverts is employment plummets. Unfortunately, you can't have a soft landing when your economy is stuck between a rock and a hard place. And in this situation, the rock would be economic pain and the hard place would be dollar devaluation. Essentially, the question is, are policymakers going to sacrifice the economy or are they going to sacrifice the currency? There's a fork in the road ahead of us and there's no middle path. If you're one of those people that over the last 2 to 3 years has traded every single cycle incorrectly, buying things at the top, selling things at the bottom, and you're sitting there wondering how you're going to make money on this next phase, don't worry, I've got the Black Friday deal for you. You can join Heresy Financial University and I will teach you everything you need to know about making money in both up and down markets while limiting your risk. And right now, if you sign up for the annual plan, which is already a discount compared to a full year of the monthly plan, you can use code Thanksgiving to get your first year for half price. This deal expires on Cyber Monday, so don't wait. It's going to go quick. As always, thanks so much for watching. Have a great day.